Hello, students. My name is Mr. Sesi George, a financial accounting teacher. In today's class, we are going to discuss accounting concepts and conventions by starting with the meaning of accounting concepts, the various accounting concepts. Then we look at the meaning of accounting conventions and various accounting conventions. All right, so let's get started. What are accounting concepts? They are nothing but basic assumptions on which the financial statements of a business are prepared and presented. The basic assumptions, write it down, on which the financial statements of a business are prepared and presented. Okay. Now, the various accounting concepts includes: number one, business entity concepts; number two, money measurement concepts; going concern concepts; the periodicity concepts; historical cost concepts; the dual aspect concepts; realization matching concepts; and accrual concepts. All right, so let's take them one by one. Business entity concepts. This concept states that the business should be kept separate and distinct from those of its owners and other businesses, okay? Which means that there should be a separate book. The business should keep a separate books for the owner, and the owner should be treated as a creditor to the business, okay? That is business entity concept. The business should be kept separate and distinct from the owner. Then secondly, we have money measurement concept. The money measurement concept. This concept of business states that the business should only record transactions that can be stated in terms of a unit of currency. You only record transactions that can be stated in terms of a unit of currency. Examples of unit of currency: we have the naira, the dollar, Sierra Leonean dollar, the pound sterling, and so on. All right, that is money measurement concepts. Then thirdly, we have the going concern concept. The going concern. This concept states that the business will remain in operation for a very long time. So as per this concept, fixed assets are recorded at their original cost and depreciation is charged on them. All right, because of this concept, other parties can either enter into long-term contracts with the business enterprise. That is, the concept assumes that the business will continue to exist for a very long time, so it makes other parties to enter into contracts with the business. All right, that is going concern concept. The next one is periodicity concept or time interval concept. This concept states that the entire life of the firm should be divided into time interval, which is known as accounting periods, and it should report the profit or loss of its operations over a specific period of time. All right, over a specific period of time. That's why we have statement of profit or loss for the year ended 2015, the profit or loss from the operation of 2016, and so on like that. So this lifespan of business should be segmented into accounting periods. All right, that is periodicity concepts. Then historical cost concepts. This concept states that the business should only record its assets, liabilities, and equities investment at their original purchase costs. All right, then the dual aspects talks about transactions to be recorded twice: debit side and the credit side. All right, that is dual aspects. That's why we have assets equals to liabilities equal plus equity. All right, then matching concepts. The concept states that all revenue at a particular accounting period should be matched against that cost for that period under consideration. That is, the revenue, for example, of 2015 should be matched against the costs of 2015 to ascertain the profit or loss for that period. All right. Then the accrual concept states that revenue should be recognized in the book, not when cash is paid, not when cash is received, but when it is incurred. And expenses should be recognized in the book when it is incurred, not when cash is paid. Okay, that is accrual concept. Then we talk of accounting conventions. Conventions, they are practices that are generally accepted and that must be embraced by the accountants. All right, we have the consistency, which states that any principle or any accounting method that is adopted must be followed from year to year. You must be persistent with it from year to year until a better method comes up. Then we have prudency concept. You must not anticipate for you must not anticipate for gain, but you must anticipate for losses in the book. Okay. Then objectivity principle states that every transaction should be treated in a manner that is free of bias but generally acceptable manner. Okay, you can, that is accounting conventions. So try to revise, to replay the video for proper understanding. All right, so I think, thank you for giving me your time. Okay, I remain Mr. Sesi George, a financial accounting teacher. Always remember to remain safe. Bye.